Are you afraid to invest in the stock market? You're worried about all your investments going from green to red? You see what I did there? That was pretty cool, wasn't it? Well, today I want to give you a few pointers for beginner investors that I've learned going through my own journey that can help you have a little bit more bliss. All right, guys, if you're new to the channel, first of all, welcome. This is the Sweet Life channel where we talk about smart investing. And yes, I am a long-term holder that believes in giving yourself a raise. If you like the idea about giving yourself a raise every time you buy a stock, tap the like button down below. Helps the video, helps the channel, and I certainly appreciate it. A lot of times, we're plagued, and I mean that. We're absolutely plagued by all of these different hype stocks, hype videos that talks about, hey, you need to get into this stock or do this or do that. This is gonna be awesome. You're gonna make a ton of money overnight. And then you find yourself a little bit afraid because maybe you got burned in the past. You put your money into something, it went down, you freaked out, you sold your shares, and you came up with a loss. Now, I don't know about you guys, but I don't appreciate putting $200 down on a stock, selling at $100, which means I lost $100 of value. That's not the game of investing. You don't wanna sell at a loss. You want your $200 that you invested to become a lot more. You see what I'm saying? If you're nervous about, if you're afraid to do investments, you're afraid to get into the stock market because you don't want to get burned again, take the dollar cost averaging strategy to the next level. Here's exactly how it works. Basically, anytime the market dips and you're invested in a company that you know, trust, and believe in, you've done your research and you're happy with that particular stock or ETF, invest more. Always have money that you can budget on your monthly budget to invest more money. So for example, let's say you're in love with company A. You've done your research, they have solid financials, they have a strong growth potential in the future, and they pay a dividend and everything in between. Beautiful stock, has a lot of upward potential. You put in money, and let's say it's $100 a share. And then all of a sudden the $100 turns into $50. I'll stick with my same example. Well, now it's a buying opportunity. It's not, oh my gosh, this company's going down, I need to sell it. It's no, this is exciting. This company dropped, and I have confidence that it will come back up. Now, your average share price was $100. You bought one share at $100. But now you can average down because now instead of just buying one share at $100, you can buy two shares at $100 because it's only going for $50. Anytime the market dips, anytime the market crashes, I get more intense with my investing. That's kind of a secret that a lot of people don't pick up on. You don't buy high and sell low. You buy low and you sell high. So if you're feeling a little bit nervous about the stock market, I'm going to pull up my iPad and we're going to walk through an example of why dollar cost averaging strategy can help you feel a little bit at ease, taking the other points that I mentioned earlier in mind. So we're going to go back to company A. And this time company A for this example is going for $10 a share. And that's its stock price when you first start getting into investing. Now, your goal is you found some budgetary cuts. Let's say, for example, instead of going out to dinner every single month, you cut down one dinner and you decide you're going to invest $10 per month into the stock market, into company A. And you're going to set it on autopilot, which means every single month you're going to take $10 and invest it into company A. So in the very first month that you do that, company A is going for $10 a share, which means because you put $10 in that month, you got one share of company A. And then in the second month, things go like pretty darn south. And all of a sudden, it's now going for $5 a share. Now, the nervous people get scared and they're like, oh my gosh, should I cut my losses and just sell? But you're smarter than that. You're going to continue on investing and dollar cost averaging because you have your budget of $10 a month. So now that it's only going for $5 a share and you're still investing $10 a month, you're now going to be able to pick up 2 more shares, which means your balance is now 3 shares. You take this plus this, you now have 3 shares of company A in your second month. Let's say in the third month, it goes up to about $8 a share. But because you're investing $10, you're actually going to receive a little bit more at 1.25 shares. And that's a fractional share because, of course, you're doing $10 on an $8 share price, which equals 1.25 shares. Which means out of this and this, your portfolio balance now has 4.25 shares of company A in the third month. Here comes the fourth month. In the fourth month, the share price goes back up to $10, all right? Which means you get, of course, 1 share, which means your portfolio balance with this and that equals 5.25 shares of company A. at the last month, at the 5th month, in this example, it goes up to $15 a share, okay? So it's $15 a share on your final month here in this example. And because it's a little bit more, now you're not going to get, because you're only investing $10, you're not going to get as many shares as you typically would. You're going to get 0.66 shares because your $10 cannot afford at this moment an entire full share of company A. But that's okay. What we'll do is we'll add the 5.25 plus the 0.66 shares, which means your ending share price at the 5th month is 5.91 shares. Okay? So you have 5.91 shares of company A. But what is your dollar cost average price? Now, what I mentioned earlier is, of course, a lot of people like to sell right here at $5 because they freak out. Or they're going to sell at $15 because they think, oh, I made $5. Don't do that. Dollar cost average. Buy the dips. This is the dip. Right here's a dip. Right here's a dip. These are the dips. And that's when you want to continue to invest. But if you're doing your smart strategy of $10 a month no matter what, you're going to continue to just keep on going. There's a formula that you can use to figure out what your average price for this entire period is, okay? So for your 5.91 shares, what we want to do, of course, I'm going to open up a new tab so we can understand what we're looking at here. Your average cost equals your invested amount divided by number of shares purchased. If I can write that right. And so let's plug that in. So your total amount invested over this period of time would be $50. How I got that is because we're looking at 5 months here. You put $10 a month in, so that's $50 that you totally invested. That means your average cost equals $50 divided by the number of shares purchased. I'm going to hop back over here. The number of shares purchased again is 5.91 shares. 5.91 shares. Now let's do some math. $50 divided by 5.91 shares equals your average share price is $8.46. That is your dollar cost average. And that's why I think it's so important to consistently invest. That way you don't have to worry about timing the market. You don't have to worry about if it's up, down, sideways, or inside out. It doesn't matter at all. What matters is that you continue to invest. But check out what's really cool about this. Your $8.46 means that as long as the share price of your current invested amount is above $8.46, that means you have profit in your portfolio. You have a positive P&L. And even though you had some shares that you bought at $10 or $15 or whatever the share price would be, your average cost is what matters. And if you buy the dips, you average down that cost. The more you do that, the more you can celebrate when your portfolio goes above your average cost. That's why I get more insane in the stock market when it crashes. As long as you have capital and money available because you're smart about how you make money and how you budget money, you'll have the money available to go bullish when the world is bearish. And if you do that in the right way, with the right type of companies, with the right type of research, you, my friend, will live your ultimate sweet life. Tip number 1, never, and I mean never, ever, ever, sell at a loss. I already mentioned that, but I want to really reiterate that. So many people come to me and say, hey, the market is going down. Things aren't looking good. What do I do? Should I sell? Should I just cut my losses? If you ever thought to yourself, should I cut my losses? You should just shut off whatever brokerage you're using, turn off the computer, turn off your phone, and forget about it. You have got to not get into the hype of trying to worry so much about what the market is doing. You've got to do your research. I'll include a link to a video down in the description that can help you do some quality research so you can make sure you're making the best investment decision for you. But you don't want to just try to get in on something to try to make money and freak out and sell and lose your sleep overnight. So what goes hand in hand to that is tip number 2, and don't invest money that you're not willing to lose, just in case. Because what'll happen is if you needed this $200 to afford your rent, and you're hoping you can put it in today and tomorrow maybe withdraw $400, typically it never happens, right? What'll happen is you'll lose money and then you're gonna be stressing out and you'll lose your $100 because you're gonna sell for only $100. So only put money into the stock market that you're willing to lose. Think about it this way. I'm gonna take my money and I'm gonna set it on fire. If that doesn't like kill you inside, if that doesn't make you freak out and run for the hills, then you can consider investing, because at that point you're okay losing the money or losing the value and being smart and being able to say, yeah, whatever, it's down $100, I'm just holding on to it. Even if it takes 10 more years, I'm holding on. Because if you look at this chart right here, this is the S&P 500, and I want to take a look at a few key points. Look at how it turns down, both in the financial collapse of 2009 and then again in March of 2020 during the pandemic. Now, if you were just starting off right before either one of those downturns, you probably felt that, obviously, because your money went to hell. And you're like, oh man, I'm losing all my money, this sucks. But if you just hold on for a little bit longer, look what happens. It not only rebounded, but it continued to go onward and upward. So if you just have a little bit of patience, typically the market will respond, because if you do it right, you'll be able to retire at an earlier age than the age of bloody 65 in America and get yourself set up for future financial success. I hope this video was helpful. Tap the like if it was. Here's some other videos that could help you in your investment journey. But until next time, we'll see you on the next video.